At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at goldsilver.com.
Hi, this is Mike Maloney, and I have Adam Taggart with me once again. Adam, how are you doing?
I'm doing great, Mike. It's great to be back on here with you.
Yeah. I watched your interview with Lance Roberts. You do a weekly wrap up each week with him. I'm a big fan of Lance. He does a great job. But he mentioned some things that you may want to tell us about. What were the key things that he talked about there that sort of stick out to you?
Sure. Thanks. I love doing those weekly recaps with Lance. He is great, as you say. And we've been tracking in the past several weeks, kind of what's been going on with the markets. Unless you've been sleeping under a rock recently, that the markets have really been battered and bruised. Obviously, it's been one of the worst starts of the year ever for the markets. We've rarely had both stocks and bonds down this low this early on in the year. So a lot of our conversation was sort of like, where are things headed from here, right? Because we are getting to some key technical levels where if we punch beneath them, there's a pretty good argument that there's a lot of air, there's a big air pocket below, and we could go a lot lower than we are today. And Lance, I would say, is sort of long-term skeptical / pessimistic of the markets. But in the short term, his job is to try to figure out what's going to happen in the near term, because he's got to shepherd capital and work to develop a return for his shareholders. He is looking at the current near-term oversold ratings on a lot of different assets and noting that they are far beyond their normal trading ranges. And in the case of bonds in particular, we were looking at, and he was showing that bonds have sold off harder this year than they almost ever have in the entire trading history we have for bonds. I think he said they haven't sold off this extremely since back to 1780 something. It was some ridiculously far back data point. And we're 4 standard deviations beyond trend right now. So what that means is simply that the odds of some sort of snapback, some sort of short-term relief rally or bounce in the markets is more likely here than a rollover. But, we've got some pretty big tectonic forces kind of wrestling for control here. So, he's leaving himself open to being surprised here. But he's saying, hey, look, if you're trying to figure out, what's going to happen next year, and if you're one of the people, sort of like us who've been watching, these videos and hearing all the pessimistic reasons we have for why we're kind of worried about the markets on a macro sense, it doesn't necessarily mean that kind of Armageddon is happening tomorrow. So he's basically saying, as many fundamental reasons as we can list for why this market should kind of crash and crater from here, it may not in the near term.
Yeah, I was also looking when I was watching your interview. He was talking. I think when he talked about the 4 standard deviations, I think he was talking about at the rate at which they are raising rates. I'm not sure. Maybe it was just the sell-off that he was talking about, but the rate that things are changing basically is. And one thing he mentioned is that historically, whenever it gets anywhere near these levels, something breaks in the economy, and so he's expecting some big reaction in bonds. But a couple of the things I just. A couple of weeks ago, I made a series of videos, all in just 2 days, and then they were released over 2 weeks. And the markets were up at 40. The S&P 500 was up at above 4,400, and today it's currently at 3,975. So we've had a 10% drop since I did the bubble update videos, and technically, it doesn't look like this is over with. It looks like this could get a lot worse before it gets a lot better. What's your feeling?
Yeah, well, like I said, I think we're at a really key inflection point here. I sort of feel like we're teetering on the knife's edge here, where there are a ton of reasons why the market could and I think fundamentally should go lower from here, and potentially much lower. But then we have all these oversold readings that I was just talking about, right? A key number to look at is you mentioned that we dropped just below 44,000 on the S&P right now, right? We closed below it yesterday. The market tried to get back to, it was green this morning, but that failed again. So we're now back to red. And going back to Lance, Lance said, look, just punching below 4,000, which has been an important technical support line. He said it's important, but it doesn't really become important until we hang out here for a couple of days. So, it's going to be, I think within about 48 hours, Mike, we're going to kind of know whether or not, we stay below here. And if we do, that then is broken support. And then we could potentially go down further. And as you and I were talking before we turned on the cameras here, there's not a lot of support until you get to like 3,500. And then the next support line from there is about 3,000. So, things could really begin to waterfall in a hurry if we end up, staying down below 4,000 here for very long. If we do, though, crack back above it, that gives us the opportunity to sort of invalidate that violation of the support and could set us up well for a bounce. And again, going back to oversold, when things get this oversold, this extremely, this quickly, you do get to a point where sentiment gets so negative that it doesn't take a lot of positive news to trigger one of these relief rallies. In fact, you don't really even need positive news. You just need not that negative news. So, again, I think, even though I don't like to say this if I'm talking about the odds, I still think we're likely to have some sort of bounce from here. But that being said, if we don't, I'm not going to be surprised at all, because you and I have been tracking the fundamental reasons why this pig of a market should correct a lot further.
Well, one of the things I always look at is just the general sentiment. And when everybody is on one side, that's when usually the opposite thing happens.
Right.
And when you look at all the articles in the news, it's all negative and the markets are going down and it's time to save yourself and everything. So we may have a rally just based on the markets doing what they typically do, doing whatever squeezes the most out of all the investors. So, one of the things that we were talking about earlier is like exchange rates. I am expecting and have been expecting the dollar to go to about 120. Brent Johnson, I had dinner with him a couple of weeks ago, and he came up a long time ago with the dollar milkshake theory, where there is so much dollar denominated debt held overseas, and they have to pay off that debt, and they get squeezed as the dollar rises. And so as there's demand for US dollars to pay off the dollar denominated debt, it causes the dollar to rise. And so I'm expecting 120 on the US dollar index one day. And we are at 104, I believe it is 103.8
104,
right
yeah.
now. And we've just broken above 104 a couple times. If we go up above 105, there's very, very little resistance. Now, this is technical analysis, and technical analysis doesn't always work. There's a lot of hocus pocus to technical analysis. There's a lot of truth to it, though, too. But 120, like I was saying, this is the time to take a trip to Europe, or right now, as you were mentioning, Japan. Japan has lost how much since 2020? The Japanese yen, what percentage of purchasing power has it lost?
Oh, it's been almost about a 30% devaluation. And really most of that's just happened in the past, really the past couple of months. Japan's a really good example here because, the Bank of Japan is intervening there, just like the Fed is intervening here and the ECB is intervening in Europe. And what they have decided to do in Japan is yield curve control. So they basically said, look, we are not going to let yields rise here. So, right now in the States, yields on a lot of our debt's been rising. And right now the Fed is basically letting that happen. And it's uncharacteristically based on its, the past decade, it's actually stepping in and helping out by continuing to try to raise the Fed funds rate. In Japan, they're kind of doing the opposite. They're saying, look, we don't want rates to rise any higher than they are right now. And that's because Japan has been fighting deflation for a long time, and they are incredibly over leveraged. And so what's happening there is in the U.S., the rise in yields is basically the bond market saying we're getting more nervous about what's happening here, and we want to be compensated for it. Well, in Japan, because they're saying we're not going to let yields rise, the way in which the market is basically rebelling against the central bank there is saying, okay, well, we can't move around rates at all, so we're going to devalue the currency. We're going to value your currency less, and so that's been a huge driver of the current drop in the yen versus the U.S. dollar right now. And I think the key takeaway from that is no matter what the central planners try to do in terms of controlling reality, there's always a way in the end where the market is going to make them pay for it.
Yeah, the market always ends up winning. And everything that we were just talking about sort of shows the stupidity of fiat currencies. I mean, this is an idiotic system.
It's hubris.
When we used to use gold and everybody was using the same money around the world, and international payments were done in money instead of fiat currencies, the exchange rate didn't change. What would happen is the economies would change. As a country experiences a boom and feels wealthy and imports more goods, they're paying in gold, causing a deflation in the boom country and causing an inflation in the country that's experiencing a recession, and it balances the economies automatically. So it isn't some government manipulation or central bank manipulation of asset prices, whether it's debt or whether it's pumping up the stock market or whatever, that causes all these huge booms and busts and these big swings in interest rates and exchange rates. You did yesterday, you sent out an email, and it just was interesting to see returns on things year to date. U.S. government bonds, minus 11.2%. U.S. corporate bonds, minus 13.9%. S&P 500 index, minus 16.8%. The NASDAQ, minus 26.6%. Bitcoin, minus 34.1%. But when it comes to gold, gold opened the year at, I'm just going to January 2nd, it opened the year at $1,829, and it's currently at $1,843. So as of your email from yesterday, it was still plus 3.1%. So gold is absolutely doing its job. It's preserving people's wealth. All the rest of the asset classes that you listed, minus 11.2 to minus 34.1%, gold plus 3.1%. So even though people aren't rushing to it yet, even though it hasn't exploded in value like it will one day, it is preserving people's wealth. So what's your feeling on gold versus the US dollar and all of the other bubble assets right now? People have been calling this the everything bubble. And for the past 3 or 4 years now, I've been calling it the almost everything bubble because gold and silver are not in a bubble.
Yeah. And I think longtime precious metals holders were getting some optimism at the beginning of this year when we started having, gold get back up in the, above 2000. And of course, it's come down since then. Now, as you rightly said, it's still up for the year, right? So gold's still doing its job. But I think, folks were hoping that gold was finally beginning to get its day in the sun. And I want to let people know all of the fundamental reasons why Mike and I talk about a much brighter future for gold and for silver. None of those have changed. I believe in them as fervently as I have to date. What I do want to help folks understand is part of why gold has been weak of late is because, when everything is getting sold, we had the everything bubble. Now we're kind of beginning to have the everything, bubble deflation, maybe leading to bubble pop, right? Is when so many things get sold that much that fast, investors start having to sell anything to be able to meet what are called margin calls. Margin debt is used to basically buy assets. It's like almost buying assets on a credit card. And the brokerage you buy them through basically says you've got to maintain a certain amount of collateral in your brokerage account relative to your margin debt. And if the assets that you used margin to buy fall below a certain level, it basically tells you, it says, look, you've got to put up money right now into your account as new collateral against this, or we're selling the other stuff that's in your account. So there's an awful lot of forced selling going on right now that typically, drags the price of gold down along with everything else when you kind of have these sharp market drawdowns. I think that's driving a lot of what's going on here. Right before you and I hopped on here, Mike, we were talking about how, there is absolutely no law out there that says that gold and the US dollar can't rise together. And it certainly has happened many times in the past. And it tends to also happen in times of great stress. And, I agree with you. I think that when the factors that we've been sort of warning about really begin to manifest in full force this year, continued corrections in stocks and bonds, maybe a correction in the housing market, the periphery countries start failing and people start rushing into the US. You're going to see, I think, the dollar go to 120, like you said, but you're going to see a lot of that money start flocking into gold for all of the reasons that we've been talking about. So my big point is don't lose faith here, folks. What we're seeing happening in gold right now is totally explainable by the margin calls that I just mentioned. And Mike, I just want to underscore InstaVault. When you guys launched that product, I was so happy for it for a couple of reasons. One, to your point, it makes it easy for people to finally get positions in gold. If they can't afford to buy a lot of coins, because coins are $1,800+ right now each, it lets you begin to create some sort of dollar cost averaging process with no matter what you can afford, whether it's $10 a month, $100, whatever, right?
Yeah.
Also, to your point, it's really important for folks to understand this, is when the demand for precious metals go up, the premiums that you have to pay on them go up. And what I like about InstaVault is it is by far the most affordable way to buy precious metals. And so right now, like you said, Mike, where the premiums are still pretty high, especially on things like silver, being able to use InstaVault to buy gold and silver at low premiums at today's lower prices is really a big gift for precious metals owners.
Yes, it is. But you said that you sort of inferred that gold wasn't performing, and it is up year to date. But the big thing is that even with the little bit of a pullback that it has had recently, that pullback is just finishing up something called a cup and handle formation. And it's still this perfect, there's a big, huge cup that's like 10 years and then a little handle that's a couple years long. It's just finishing that up. And this is one of the most bullish formations there is. It's also an inverted head and shoulders pattern. And so this is projecting that when gold passes that, let me see, the highs were almost, it was just under 2,100, 2072. And so when it passes, it's a double top at 2072 and 2069. When it passes that level, we should see a very quick move up to much, much higher levels, $2,500 very, very quickly. And who knows, maybe it is off to the races from there. So I want to close this up, and I'm going to just cover two little things at the very end here that I think are just hilarious. One is the European Central Bank President, Christine Lagarde, rejects calls by staff to link their salaries to increases in inflation. So the central bankers all want their salaries to be linked to the inflation that they have caused. This is their fault. and they want to get compensated for this thing that is punishing the entire world. This is hurting everybody, and they want to get compensated for it. Which brings us to the next, the meme of the day. Government, if you think the problems we create are bad, just wait until you see our solutions. Thanks, Adam.
Thanks, Mike. Wonderful as always.
See you next week.
At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at goldsilver.com.